Will banks really fund up to 90% on a franchise startup with an SBA loan? And the answer is yes. But we're going to dive into which loans actually qualify for 90% financing in general. So there's certain lenders out there that are pretty good in the franchise startup space. Not all banks like to do franchise startups. Some banks say, hey, we like the really established franchises that are brick and mortar, but they won't touch working capital type deals where there's no build out. There's a lot of home service business models. You don't need a brick and mortar location. A lot of these business models are loan amounts are under 250, and some of these banks only want to fund 350, 500,000 plus deals. And to kind of circle back, is 90% financing available? And the answer is absolutely. Now, the majority of banks do not do 90% financing, but we have a handful of SBA lenders that will finance up to 90% of total project costs. And generally, they're looking for, first, the franchise itself. One, is it on the SBA directory? Starting in June, we had to go back where every potential franchise needs to be listed as an approved franchise. Now, the SBA directory doesn't mean just because they're on the list means they're vetted out and they're a great franchise. It just means they're eligible for finance. Banks and non-banks and credit unions make these loans, and the SBA or the federal government guarantees a certain percentage of that loan based on the loan amount. And so now we're unpacking these 90% deals. Which deals are eligible for 90% financing? First, we're going to start with the franchise itself. Are they an established franchise? Do they have many locations? Is it brick and mortar or non-brick and mortar? Once I understand the name of the franchise, we'll pull the FDD, which is the franchise disclosure document. I'll have several conversations. Now let me rewind a little bit. How I work in this equation is I am a SBA loan advisor, and I work with various banks and non-bank SBA lenders. So my job really is to talk to the candidate or the borrower and find out what their investment, what franchise or what franchises they're looking at, and what their fundability might look like for that particular franchise. And then I essentially help them get the package ready and match them with the right funding source. So there's a couple main players in the franchise financing space. Obviously, there's the big top five that are doing the majority of loans in general in SBA in the franchise space. Then there's the one-off banks that will do things, if it's a local deal. And then there's certain banks that have a national footprint. So in general, the banks that will do 90% financing, one is it has to be a franchise that's approved not only on the directory, but at their bank level, and they might review the FDD and then make a determination if they haven't worked with that particular franchise in general. Some banks often use a scoring model by a third party called Frandata, and they'll do a scoring of the particular franchise, and if the franchise scores a certain number, they'll say, hey, we would entertain a deal at 90% on this particular franchise. In general, most of the banks like to come in around 80% of total costs, but there are a handful that will do 90%. So the first thing that's important to understand is the franchise itself. Then going to you as the borrower, we're looking at your credit. Do you have a current W-2 or outside income? We're looking at transferable experience. Although it's a franchise, I still like to see that you have some relevant experience. It doesn't have to be in the particular industry, because most people that get into a franchise don't have industry experience in that realm. They are just investing into a franchise because of that. So once we understand that and the total project cost, because we have some banks that will do small deals up to 150 loan amount, and they'll go 90%. Some of them want to do 150 and above. So that's how we kind of take all the information we're getting and then figure out, hey, what's more probable? In general, they want to see that you have 10% post-close liquidity. So what does that mean? You have a $300,000 deal. You put down $30,000, which is 10%, or $60,000, which would be 20%. And after you put that down payment or equity injection, you had 10% of the total project costs left over in reserve. So you had 30,000 liquid. That's kind of the rule of thumb. That's not a definite no if you're not quite there. It's just rule of thumb. Generally, you have to score on the SPSS credit scoring. The minimum score is 165. It goes from 0 to 300. That is a credit scoring system that was built by FICO for SBA loans, and every bank is pretty much using an SPSS credit score. Some banks now require at least a 180, and if they go over lending thresholds, they might say, yeah, we'll do that loan up to 250, but we would require a 190 SPSS credit score. So there's all these variables and it's very fragmented. But the answer is yes, we can help you get 90% financing, but it's got to make sense. You know, if this is your first business and you're pushing the envelope and you don't have much post-close liquidity, sometimes they say, hey, we could fund this, but we'd be at one territory. We can't finance the expansion of you starting with 2 territories. So once we understand that, that's where we're at. And that's how I help you navigate all these systems. The reality of it is the 20% down deals are generally easier if you have an established franchise and you have 10% post-close liquidity and good credit scores and outside income. Makes it my job a lot easier. Every day we are looking for new relationships. We work with some big major banks. We work with some credit unions that specialize in, they have a national footprint and they can lend nationally as opposed to just geographically. But most of the major banks we deal with, they'll lend anywhere. They have a national footprint when it comes to SBA financing. There's lots of variables for franchise startup financing, but in the big overarching theme is 20% down, 10% post-close liquidity, established franchise. If it's a really strong franchise, we can do 90% financing, 10% equity injection only, and then you should have around 10% post-close liquidity. But have I gotten 90% deals done where they only had 2,000 or 3,000 left in liquidity on a $150,000 loan amount? Absolutely, because it makes sense because we're building a lot of working capital into the loan. So I know I went on a rant about 90% financing. It's out there. I need to know the story and I need to know the franchise you're looking at. Go to bookwithbeau.com, bookwithbeau.com, schedule an SBA discovery call for franchising, and we'll figure out what the best loan program for that particular franchise is, how much working capital that you bolt on. Remember, when you're looking at the FDD, which is the franchise disclosure document, in the item 7, they have a low to high investment range. A lot of times they're only allocating 3 months of working capital. Usually you need more than that. So I can give you some of the tips and tricks to help you really understand what you're getting into and making sure you're well capitalized, because once again, most businesses fail in the first couple of years because they're undercapitalized. Go to bookwithbeau.com. Thanks for watching. If you're a solopreneur or small business owner, listen closely. Business growth isn't about working harder. It's about building smarter systems. It's about automation. And that's exactly what Go High Level Hire helps you do. Build your funnel, automate your follow-up, manage your team, all in one place. Click the link below, activate your trial, and see how much more efficient, automated, and profitable your business can be in just 30 days. Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.